Welcome back. Today we're talking about credit scores fully explained, and we're going to dive into credit scores, what they're like, what their range is, where in the heck they come from, what they're made up of, how you can get a good one, and all of that stuff. So if that's interesting to you, please be sure to stay tuned till the end. My name is Stephanie, and I've been helping people with their mortgage financing for 18 years. Whether you're moving in 9 days or 90 days, give me a call, shoot me a text, or send me an email so I can help you with your financing. My team can help in multiple states, and we're at 985-300-LOAN, or weeksteam.com is another option. So thank you for tuning in. If you are back to the channel, thank you for coming back. And if you're new, welcome. Please be sure to like and subscribe, and don't forget to share the video as well. My passion is mortgage peace, and I want to spread this through the world and give people knowledge that they can apply, because applied knowledge is power. All right, enough of that. So what is the credit score and how is the calculation to get the credit score? We're going to fully explain that here today. So the credit score is really just a report of how well you handle your life and your money. The national average is like a moving target when it comes to the national average credit score. I have seen, it's been a long time since I feel like it was around a 640. In the last many years that I've been tracking it, it seems to range between a 680 and a 720. So let's kind of go in the middle and say average might be around 700. When it comes from the mortgage lending perspective, anything above 740 is considered excellent. When it comes to a lot of other industries, they consider 760 and above to be excellent. The credit score ranges are from 300 to 850. I've seen thousands of reports, and it's very rare that I see scores over 800. Scores are basically comparable to being back in high school and getting your grades, because your mortgage payment history might be like an exam. It's going to weigh more heavily on your grade than something else, like maybe your credit utilization on your credit card might be more of like a quiz grade, right? Whereas if how long you've had an account might be more of like a homework grade. And the more things that you have to grade, the more likely that you have to have a credit score and to generate a credit score. And how those things are reporting and how you test on each of those will determine whether you're on the lower end of that spectrum, the average spectrum, or more on the higher end of the spectrum, being above the 800. The more responsible that you are, the higher your credit score is going to be. Meaning, if you pay your bills, good credit score. If you pay your bills late, 30 days, it's going to knock you. If you're 60 days, 90 days, 120 days, it's really, really, really going to knock you. If you don't pay things, they go into collection, it's going to hit the score. Repossessions, going to hit the score. Voluntary surrenders, going to hit the score. Foreclosures, bankruptcy, those things are going to hit the score. Those are all having to do with negative and late and not paying, right? And then you have your credit utilization. That's going to hit the score. How many credit cards do you have? How long have they been open? What is their utilization in relation to what's available? Like, do you have $1,000 in limits and you owe $950? Because if you do, that's going to hit you negatively and impact that score in a negative way. You're kind of getting the drift here. So why is it important to have a good credit score? I had somebody tell me earlier today that someone told them that, the credit score, I think it was like a Dave Ramsey thing. The credit score doesn't matter. Well, guess what? It does matter, because even if you want to get electricity, they pull your credit. You want to get a cell phone? They pull your credit. Like, they're pulling your credit for just about everything except for, like, I guess if you want to get like those apps that you watch television shows on or something. I mean, almost everything else, I feel like they're going to pull your credit. I mean, even employers these days are pulling your credit. So you are wrong, Mr. Ramsey, on that one, if that's what you're telling people. That's for darn sure. You have a lot of right things too, but definitely wrong on that one. So here are some perks of having a good credit score. You're going to get the lowest interest rate available. That comes to your credit card interest rate, your home loan interest rate, your auto loan interest rate, your line of credit interest rate. You're going to get the better or best available interest rates, the better the credit that you have, which means the money is going to cost you less overall, which puts more money back in your pocket. It can help you to make money by being able to invest. If you've got good credit and you want to go get loans to invest in real estate, well, that's going to help you to earn money and build wealth through things like that. If you have bad credit, you're not going to be able to get those investment property purchases that you might want. Let's say they have sign-up bonuses for things like get this credit card and we're going to give you $1,000 back. I wish they would, right? Usually it's like $100 or $200. But if you've got great credit and you get approvals for those things, then you're more likely to get signed up for those perks and those rewards, which again puts even more money in your pocket. So you're less of a risk. You're more likely to repay with those good credit scores. And you're going to get a discount on things, and it's really going to be super, super beneficial. So you want to stay on the higher end of that credit score. Now, I'm going to break down into five pieces of like what comprises the credit score. The first thing that goes into this is the payment history. 35% of your final grade is your payment history. Remember, that might be like an exam grade. Okay, it weighs a lot heavily. This one's very important. Don't miss a credit card bill. Don't pay your bills late ever, ever, ever. Just make those minimum payments to keep things going, okay? Now, in the whole scheme of things, don't just make the minimum payment, get yourself out of debt, use their money for free, don't pay interest. But if you're in a situation and you have to make a decision, do anything you can to make those minimum payments so that it does not really detriment your score really, really quickly. Second, credit utilization. This is 30% of your final grade. And what is that? Like, what are you using? So let's say that you have a $10,000 credit limit and you've got a $6,000 balance. Well, you're using 60% of what's available. If you really want to be super, super great, keep it below 10%. Most people can't, most people don't. The general rule is definitely keep it below 30%. So that $10,000 really needs to be less than $3,000 and definitely not the $6,000 because that is going to negatively impact that part, which is 30% of what your credit score is made up of, right? So here's a quick tip. You do not have to keep a balance on your credit card in order for the Bureau to have something to report. That's actually a myth and will only cost you money because you're going to pay interest on those balances. So that's a real, real important one. The third is the length of credit history, which is 15% of your final grade. And that might be like the homework grade, okay? This just means how long you've had the credit for. We call it in file. We call it trade line history, things like that. So if you've got a credit card that you've had for 10 years, well, and that's your oldest account, then you've got a 10-year in file, basically. Here are some tips with length of credit history. The first thing is you want to build your credit as soon as you can. So you've got to be 18 to start building that credit. You want to keep them in good standing, of course, but you really want to get something, whether that be a secured credit card or an authorized user on a credit card or a secured loan, something as soon as you're 18 to start building that credit. Credit history tip would be if you've had a card open for 10 years and you've had a card open that's 7 years and, well, let's say 10 and 5, and you want to close one of them, assuming one is not a crazy higher interest rate, like you got to take those things into consideration too. But if all things are level and you have the one that's open for 10 and one that's open for 5 and you feel like you have to close one, close the one for 5. Don't close the one for 10. Don't open up new lines of credit if you can avoid to, because that can potentially lower your score if you add a bunch of new lines of credit. And tip for those with kids, if you want to set your kids up for success for when they become 18, get a credit card with them and help them manage it and help teach them good credit for them moving forward in the future. All right, the fourth thing that goes into that credit score is the total number of credit lines, and that's 10% of the final score. The more credit lines you have, the higher the credit limit, which lowers the overall utilization and helps your score. I'm going to say that again. It sounds a little confusing. The more credit lines you have and the higher credit limit, but the lower balances you have, lowers your overall credit utilization and actually helps you improve that score. Second, by having more credit available to you, you can show even more on-time payments, which can also help your credit score. And the other thing, the other tip in there too, is having a mix of those types, because you don't just want credit cards and you don't just want mortgages and you don't just want auto loans. You want a variety of things, but don't go get yourself in debt and pay a bunch of interest just because you feel like you have to have a variety of things. It's just something to kind of keep in mind, and it's just a tip when it comes to the credit scores, what you can do and how they're actually calculated. And last but not least, 10% is left for credit inquiries. Anytime you go and apply for credit, you've got the hard pull and you've got the soft pull, as I've discussed before. We're assuming hard pulls. This can go into the calculation of determining your credit score. So you don't want to have a bunch of people pulling your credit unnecessarily if you can avoid it. There's a really crazy stat, like if someone who has their credit pulled 6 times, it's something like they're like 9 or 10 or 90% more likely to file bankruptcy. I know that's a big sway. I couldn't remember the actual numbers, but it's huge. It's a really, really big thing. So if you're out there getting new credit cards, make sure you want to look for things that are going to lower your average credit length so that we're not dropping your score. I want to make sure that when it comes to all of these things, that you are checking your credit every single month. How do you do that? You can go to annualcreditreport.com once a year for a free copy of all 3 bureaus, no scores. You'll have to pay for scores. That would be once a year. I always like to do that. I always like to print the paper copy and go through it. The other thing you can do is sign up for some of the free apps that give you your score for the purpose of monitoring, because those apps are not giving you the credit scores that a mortgage lender is going to pull. It's different grading scales. So you want to take that into consideration as well to make sure that you know what's going on. So that's a wrap for today. Don't forget to check out my book, check out my course, call us if we can help you with your mortgage loan, check out some of the other videos. I really appreciate you tuning in. Don't forget to tell your friends and family. See you in the next one.